Rainbows to Riches.
Welcome back to Rainbows to Riches, guys. My name is Rayleigh Wells, and until recently, I had no financial guidance up to the point where I met Drew at the gym, and through him, I met Michael, his husband. And long story short, they became not only my financial mentors, but also my friends.
I'm Drew. I've run a number of different businesses over many, many years. I've also bought, sold, and rented commercial and residential real estate properties many, many times.
I'm Michael. I'm Drew's husband. We've been together about 25 years. And when I met him, I had just come through bankruptcy. With his help, I was able to buy my first property, open a business, and now we're looking at retiring.
The whole idea with this podcast is to create a safe community for us to talk about personal finance, and it's also tailored but not limited to the LGBTQ plus community. So we also talk about many aspects of our life and how our life sometimes is different and our financial goals are different than cisgender people, heterosexual cisgender people. And today we will be answering some of your biggest questions about investing. So stocks, bonds, and like mutual funds. Today, Drew and Michael are going to be talking a little bit more about their experience trading these types of investments and explain to us a little bit of what it means. If you're ready to invest, where do you start?
The answer is that there are never-ending places you can start and never-ending ways to invest. CDs are very often the first place people go to invest, certificates of deposit, because they're simple. You get them at a bank or an investment house. They pay a fixed rate of interest, and you just leave them there until they mature. And we'll have a whole episode on CDs.
But just for them to understand what exactly is.
It's a certificate of deposit where you go to a bank and you have X amount of dollars, $100, $1,000, way more. You put it into a certificate for 3 months, 6 months, a year, 5 years, 10 years, 30 years, and you can't touch it until then without a big penalty. And you just earn that rate of interest, and by and large, it is among the safest investments, but by the same token, it often pays less than most other investments that are available.
Okay. I was going to say that when you are ready to buy a CD, you can shop around and see that in one bank, for instance, if you have $10,000, you can put that $10,000 in a shorter term, a medium term, and a longer term. Based on the prediction of the economy, the rates are going to be different. So if the economy is looking optimistic, the rate might be a little higher for a long term. Is that right?
And almost,
Yeah.
So you would make more money if it's longer term.
You'd make more money, but you couldn't access that money.
And you'd only make money if it depends on what the predictions are for the long term. You can buy something, very often you'll see a situation where you can buy a CD for 3 months and it'll pay you 7% or 6%. If you buy it for 3 years, it'll pay you 4%, because who's ever making these rates and establishing them are not sure what's going to be happening 3 years from now. It's less predictable. But 3 months, they know where you are. So you don't, the amount of time you buy it for, the amount of time you're going to hold it, depends on the interest rate you're going to get and vice versa.
Okay. And stocks are really popular, especially like people around my age, I guess, like 20s, early 30s.
Yeah, there are lots of investments. There's real estate, there's collectibles, but stocks, bonds, and mutual funds are 3 of the more common ways that people who are just beginning will start to invest.
Do you want to explain mutual funds?
Well, let me go in order. Stocks represent a partial ownership in a company. If you buy 100 shares of whatever company it is, you are a partial owner in that company. And if the company does really well and their expenses stay low and they make a lot of money, the amount of money you can get can be astronomical. It's not usually astronomical. Most people hope it'll be astronomical. Michael has taken money out and put it in companies which I rolled my eyes at because he thought they were going to work. But
Well, at least you tried.
That's right.
And he did it with the money that didn't matter. It was like extra money.
To me, it was like going to Atlantic City. I
Right.
did most of the initial stock purchases during COVID because I had no reason to spend money on anything. So I calculated in my head what I would have spent if I had a regular life. And I was like, put $300 here. To me, it was just like going to Atlantic City, put some money on a craps table.
Money that you had to like for entertainment.
Yeah, like extra
Exactly.
money.
And I didn't have, if I lost it all, it wasn't going to kill me. And it did well for a while. Some of it did very well, but then everything started going down. And the mistake I made, or maybe it's not a mistake, I was told that if you have a stock you believe in and the price drops, you should buy more of it. Well, one of the stocks, I'd say, one of the stocks I bought was a cannabis stock. And everybody's saying, oh, cannabis, that's the greatest thing. And I did some research. So I bought it at, I don't know what the price was, say $10 a share. It went down to $8 a share. So I bought a couple more shares. Then it went to $5 a share. At this point, most of my portfolio is in that one stock.
Oh my God.
And it's worth like 30 cents.
Holy crap.
There's still something there. It could come back.
But not in your lifetime.
Probably not.
But
I hope it comes up.
well, we all hope it comes up. But the lesson to learn there is that buying stock in one company for a young person who doesn't have millions and millions of dollars to gamble with is not a very smart thing to do.
So just to summarize, stocks is like you're buying a piece of the camera. Stocks, you're buying a little piece of the company, and depending on how it performs, you make profit or you lose money. Do you want to explain day trading? Because it's the very first time that I heard stocks, it was people marketing day trading for you, and then you get so excited you're going to make money so fast, and you get very excited to start doing
Yeah.
it. It's the very first thing that they
Right.
present to us.
Right. The
when-
only thing worse for your financial future than buying stocks is day trading.
But it works for some people.
It worked for the people who it works for have been doing this for 30 years, 20 years, 30 years, more. I know somebody who retired to Florida, day trades every day, and is rich. But he went to Florida rich.
He started with.
He started rich.
He started already. Okay.
He started with plenty. So if you have $10 million and you're playing with $500,000, it's not so much money. And what day trading is, simply put, is you get up in the morning, you have nothing invested. You look at the stock market, at all the different stocks and how they're doing. You decide what is going to go up by the end of the day by watching trends. At the end of the day, at 4 o'clock, when the New York Exchange closes, you have sold everything you bought that day, and you have no investments. That's what day trading is.
Somebody could get very rich on a day within minutes.
You could.
If they make the
You
right
could.
choices.
You could. You couldn't.
Didn't work
And
for
to be
me.
fair, I couldn't at all, by any means. I could not do that.
It's also very high stress
It's
because
risky.
you're like watching stocks go buy that, sell that, buy that, sell that.
It's way beyond risky.
I tried signing up for one of these things that they're like, okay, you paid $200 and you're part of a group, and this group teaches you like, certain things that are on the graph, and when you should buy, when you should sell. It just wouldn't enter my
The
head.
only people who made the money are the people who charged you the $200.
But it's I think that it's kind of like a pyramid.
Oh, it's not at all a pyramid
if
scheme.
I got another person to join,
Oh,
for $200,
that part.
then I think that
yeah.
I would make money and I would not pay the $200.
Yeah,
fee
that
every month.
part is similar, not the same, but it's similar to a pyramid scheme. But day trading is a very risky
careful.
way. Don't count on making money unless you've been involved in trading for 10, 20, and 30 years. Then you have a shot. And even those people don't always make money. There are plenty of days they don't. But even buying stocks alone, very risky. And even if you're an insider, or if you think you have inside information,
Do you explain what inside information is?
Inside information is when your cousin works at Pfizer and says, we're coming out with a new product tomorrow, and you buy a ton of Pfizer.
So of an information that comes from a inside.
Somebody inside the
publicly
company,
known.
which is, by the way, illegal for you and for that person.
Right.
Totally illegal. And if they find, that's why Martha Stewart went to jail.
She went to jail because she
because of
bought and
insider
sold
trading.
stock based on something that was considered to be private information. I don't know the details of it, but she decided it was not, and she fought it and fought it and fought it and lost and went to jail. Most people would have made a deal, but she was so convinced that what she did was not illegal that she held on to the end and then ended up having to serve jail time.
Years
It's
in jail.
it's bizarre
do you-
that she went to jail for something that is kind of not that uncommon.
Because
Yeah.
she's famous.
And she's a woman.
I won't agree with that, but
I think it
you're
really
allowed
has to do
believe
with
it.
her her
Your
confidence in
president
herself.
did a lot of things that he made him he should be in jail, but he's not.
But not because he's a man, just because of the things
Well,
he's
does it
done.
not help? Maybe the fact that he's a man. That maybe he's.
I truly,
the
I
law is not
truly
as
don't believe it.
strict with him.
That's one thing I don't think I can hold against him.
Yeah, if there's one thing in the whole world that we
But
don't hold
I
against him.
again, we're getting into politics. But the idea is, if you get a tip from someone who is connected to the company, it could theoretically be considered insider trading. And if you made a lot of money off it, you could get in a lot
what
of
people
trouble.
don't also realize, and I don't want to spend forever on this, if Pfizer is coming out with a new drug, Pfizer is a multi-billion-dollar company. They're coming out with a wonderful drug. People buy it. That represents 0.5% of all Pfizer's income. So that drug does really, really well. It still only represents 0.5%. The few examples in the world, and one recent one is Ozempic, which came out, the weight
came
loss
out.
drug. When that came out, it revolutionized everything. And that became a huge profit center. But Ozempic had been around forever. It was a diabetes drug. It
but
wasn't a
nobody
weight loss.
used it to.
Oh, everybody used it to lose weight, and they thought, "Oh, good, I'm losing weight."
They
too."
started marketing it that way.
Yeah, it made
was
all the
not-
difference in the world.
It was a side effect of treating diabetes. People started
So
noticing
people
they
with
would lose.
no diabetes are taking
Now,
that shit
now,
like crazy.
and
They have
and
to watch
losing
your blood sugar, right?
tons of money, and they have to take it for the rest of their lives. This is none of our business. We should not be talking about this. My hand can be here because it's not in front of really.
You're gonna hit the mic.
I never hit the mic. Secondly, the next.
Okay.
Can you tell we're a couple?
So the thing that we are interested here, and I believe that our viewers are also interested, is how to make profit. So
Okay.
how
Before we get there, we
profit
have to
work?
define bonds and mutual funds. Stocks represent a partial ownership, your partial ownership in a company, depending on the amount you buy. Bonds are a loan. You are loaning a company or the government a certain amount of money for a certain period of time.
So it's like you're lending them.
You're lending them money. Just like when you borrow money, you borrow it, you have a year to pay it, you pay whatever interest you pay, you have to pay it off. This is the opposite. You're loaning to a company, whatever the amount of money is. They're telling you, if you give it to us for a year, we're going to give you 5%. If you loan it to us for 2 years, we're going to give you 6% every year. You can't generally, and you can do it with the government, by the way. The government offers bonds as well, both municipal for the city, state, and federal bonds. In most cases, the interest you make on those bonds, after you sell them, after you turn them in, is tax-free, which is not the case for money you own to companies. And not always the case for the government, but usually they are tax-free bonds, and they're marketed that
Which
way.
one is tax-free bonds?
The one you loan money to the city of Harrison,
That's not government bonds?
it is a government bond, the city government, to the state of New Jersey, or to the federal government, T-bills, they're called treasury bills. You loan them money, they tell you how much you're going to get, and a year down the road you collect your interest. When it's a company, you add that interest to your income. When it's a federal, municipal,
And what
or
is a
state.
mutual fund?
A mutual fund, which to me is the very best investment, certainly for a younger person starting out, is a combination of hundreds and hundreds of different companies, often in different countries, always in different industries, and also includes some bonds. So if one company goes out of business or loses a ton of money, it represents next to nothing.
So it's a combination of several different companies.
Several
Stocks in different
stocks
companies.
in
Instead
hundreds.
of buying just from one company.
Buying one company you buy and it goes out of business, you lost every penny.
And there are people who basically put together this recipe of combinations to keep things balanced. Now, when you do a mutual fund, there are different mutual funds that are considered higher risk and lower risk, right? So that you can get what they call long-term versus short-term. What is it when someone is young, they're willing to take a higher risk? And when you get older,
There
you're
are types. There are types
Longer
of
term?
no. There are types of mutual funds, which they're usually broken down into minimal risk. They all have risk, but minimal risk, medium risk, and high risk. A lot of younger people will go for high risk. High risk means you can lose a lot, but if things turn out the way they hope they're going to, you'll make a lot. Same goes for medium risk and low risk. Low risk, you usually make the least amount, but they're less risky. It all depends, and we're going to talk about this in a minute, it all depends upon your tolerance for risk.
Right. Risk has often to do with whether or not you're going to need that money.
Right.
If you
The
can let
older
it
you
sit
get,
for a
yeah,
long
right.
period, you can be a little riskier. If you need, like as we get older, we're going to need to get our money, make sure our money's available when we retire. We don't want to put it in a risky thing
And
because if it drops, then our value.
Also, if you don't really have any extra money to be playing with these things, I guess it's higher risk.
So in summary, mutual funds are a collection of stocks and bonds which are diversified over many different companies, many different industries, and in many cases, bonds and investments in other countries. So the next question we have is, how do you make money?
That's what I feel like most of us are interested in, how to make profit out of these investments.
Exactly. With stocks, you buy shares in one company at one price, and you hold them until hopefully they go up, and then you sell them. Very often, as Michael said before, you believe in a stock, it goes down, so you buy some more shares so that you've now bought them at a lower price, and when you sell them, they'll have gone up even more compared to the ones you bought in the first place. Not something I recommend, because in most cases you're trying to game a company, and it just is not something that works really well.
If it was easy, everybody'd be doing it.
Yeah.
Everybody making money, and it's just not.
Everybody would be. It's not impossible. We're not here trying to say it's impossible. We're just.
But people spend years and years and years learning how to do this, and they work hours and hours
We're
and hours.
just
It's not just going to go in and do it.
realistic.
And there's something called the Dow Jones average, which are certain stocks which are used all together to decide if the market is going up or down.
Trends.
No one, not one company or one person in the history of the stock market has ever consistently beat the Dow Jones. You can't do it. If you can, you're very rich.
Repeat what it does.
The Dow Jones is an average. So they take a
how-
whole collection of, is it
A whole bunch of different stocks.
500
of
or
how
something?
the stocks are performing, or the mutual funds are performing.
No, stocks. Individuals, they take a whole bunch of individual stocks.
Is it a mutual fund as well,
No.
or just a
No.
measuring?
It's just
No.
a measuring.
Okay.
It's just to measure. And they watch as it goes up or goes down or stays the same. And there are thousands and thousands, probably hundreds of thousands of brokers and brokerage companies all trying to beat the Dow Jones average, because then they can tell their customers, come with us, invest with us. We can help you beat the averages. No one has ever consistently done it in 200 years. You're not going to be the first. You're just not.
Don't say that.
Those
The
are stock.
the
Maybe.
internet-
If
the
you are,
internet
we
is
would-
gonna come for you.
If you are, we would absolutely love to hear about it.
Yes.
The next item are the bonds. Those you've loaned the company money. It has a maturity date. It has an interest. At the end of that period, you sell them. You give them back. They give you your money. And you buy more. You don't. But that's the end of the investment. Mutual funds you can hold on to as long as you want. And you watch them. You can watch them online every day to see if they've gone up, how much they've gone up based upon how risky they are, based upon if you've taken low risks mutual fund stocks. And you decide when you want to sell them.
To close out this section, what would be the greatest suggestion for our viewers to keep up with this information? If somebody wants to get into buying or studying or looking into mutual funds or buy stocks or however they want to invest their money, please be safe. We are risk realistic here.
Right. We're not risk averse, but we are risk realistic because there is no such thing as no risk. If the economy goes into a downswing, a serious stagflation, which is what they're potentially causing it now.
So where they can find that information?
They can find out. They can find that out. They can Google it and find out where the market is.
Is there any specific websites that you like? I know that Investopedia is a popular one.
That's one. There are just so very many. There are really none that I'm going to mention. What I follow is where I have my money.
So which is?
Which is the Vanguard Fund.
Vanguard Fund. So they have news there too.
They have
and
news
updates on
everything.
Okay.
On absolutely everything you could possibly want.
Trustworthy.
And they are as trustworthy as they come. Everybody has their own bias, and we'll be talking about who you should invest with, which companies, and should you have an investment counselor of your own? Should you pay for it? Should you get a financial planner? In which case you'll have to choose what you want to do.
Right.
The last item we have are taxes. On stocks, you only pay tax on the money that you made. If you lose any money, you can use that as a loss carry forward on your taxes. I won't even begin to explain what that means. But if you lose it, you don't
What's the
lose
name of
everything.
it?
It's a loss carry forward.
Is it like an insurance, a warrant?
No, it's
How to declare the money.
it's an accounting principle. It'll just take too long because we just have to end the episode shortly. But you can Google loss carry forward.
The only thing I want to clarify is you don't pay taxes when the stock goes up. You pay taxes when you sell the stock.
That's right.
But you
The
only
value-
have money when you sell the stock.
Right, but if the value goes up and down and up and down, has no relevance. The only time is if you buy a stock for $100 and then you sell it for $200, you pay taxes on that increase. If you
On the
sell it for
$100.
less than
$50
$100,
$50 increase.
the $100.
$100 increase. If you sell it for less than $100, there's no tax because you haven't made any money.
And you often can sell it, let's say, at the beginning of if you have made a ton of money on a stock this year and you sell it in December, you don't have to pay, or you sell it in January, you don't have to pay taxes until the following April. So you kind of hold on to that money.
Oh,
because
sell it on the following
you
year.
put it into your tax return for the following year, the year when you sold it.
Okay.
Bonds, you only pay taxes on the interest that you make. I have a note here. I can't even read what I wrote. Some bonds will pay you quarterly or pay you dividends or pay you annually. Some won't give you anything till the end of the term. When you buy it, they tell you which you're going to get. You only pay taxes on the interest that you've earned, not on the principal.
Okay.
So this basically is the information you need to begin your investments in stocks, bonds, or mutual funds. We recommend mutual funds, and we'll talk in the next episode about risk and other factors involved with your investment.
So make sure to stay tuned for our next episode, guys. We will be continuing this conversation. As you said, we're going to be talking about risk, and we will make more episodes on bonds, mutual funds, and CDs in the future. So make sure to like,
comment,
and subscribe.
Also share it with a friend because you know how much engagement helps us to reach more people out there to create this community for everyone. Thank you so much. If you have any questions, feel free to email us with overall feedback.
And we'll be very glad to answer individually if we can, or possibly make an episode out of your question. And do remember that this is for entertainment and information only.
Thank you so much. See you on our next episode.